Let's bring in Mark Anderson. Mark, what have you got to tell us about the Fed?
More Fed shenanigans and half-truths and oftentimes lies. Hopefully I'm coming through clearly. I'm at a hotel somewhere in the vast state of Illinois, on my way to Michigan for my annual sojourn there. Yeah, this first slide up, we see the economic hero, our savior of all, Fed Chair Jerome Powell, warns that to cool inflation, at least 2 more interest rate increases are probably coming. And the Fed is very slow, I might add, to calculate or acknowledge how much damage these interest rate hikes can eventually do. One of the big problems is that they know that the outcome and effects of the interest rate hikes take a while to be ascertained. And then they plan on making more of them. And the question becomes, will they even know the effects of the earlier ones before they make more rate increases? And rate increases sometimes are themselves inflationary and do not fight inflation, because there's cost push inflation where the interest rates are just another cost of doing business passed on to the end consumer. But anyway, going to the next slide, we can sort of do a bullet point presentation on this. Fed Reserve Chair Jerome Powell said at least two rate hikes increases. Interest rate hikes are likely necessary this year to bring the inflation rate down to the central bank's 2% target, the much ballyhooed 2% target, and that acting at consecutive policy meetings isn't off the table. A strong majority of committee participants, that's the Open Market Committee that meets quasi-secretly, expect that it will be appropriate to raise interest rates 2 or more times by the end of 2023, and that inflation pressures continue to run high, and the process of getting inflation back down to 2% is a long way to go. There we see more of this notion that inflation is a disembodied force that the Fed has no hand in causing. And we know that the Fed either causes it by, at some intervals, printing too much money, and at other intervals, raising rates at least excessively to where those become additional costs passed on through the business sector onto the end consumer. So the Fed absolutely causes inflation and keeps acting as if it's a disembodied force that they have no connection to. Anyway, moving on, we can kind of cherry pick this a little bit. A strong majority of committee, let me see, let's go down a little bit. In remarks to a conference in Madrid at the Bank of Spain, Jerome Powell repeated comments he's made in the 2 weeks since the Fed's last meeting, where policymakers held rates steady for the first time since early 2022. So they've only held off just most recently. Officials opted to pause then with rates in a range of 5 to 5.25%, while at the same time signaling 2 more rate increases or more may be appropriate this year. As we've said, the Fed previously raised rates at a fast clip last year, including 4 consecutive 3/4 point hikes from near zero in March of 2022. Officials started slowing the pace in December and delivered 25 basis point hikes in each of the first 3 meetings of this year, et cetera, et cetera. In a subsequent Q&A, Powell said the economic outlook is particularly uncertain, and that's a big understatement. Moving on from there, while overall inflation has cooled significantly from a peak of 9.1% a year ago, measures stripping out the more volatile and food and energy prices have come down much more slowly. And there you have something interesting. You know, energy prices are very volatile anyway. And under Biden's policies, it's gotten even worse. You have a lot of weather affecting food supplies in the U.S. So Fed measures, monetary policy oftentimes won't have much effect on those things. They're naturally volatile. Anyway, Powell said Thursday regulators are committing to learning lessons from the failure of Silicon Valley Bank and 2 other U.S. lenders, while the largest banks remain well capitalized and safe, and the size diversity of the country's banking system should be preserved. More may need to be done in overseeing mid-sized banks in the non-bank sector. And here's an important part. These events suggest a need to strengthen our supervision, the Fed's supervision and regulation of institutions around the size of Silicon Valley Bank. I look forward to evaluating proposals for such changes and implementing them where appropriate. So the Fed already is a privately owned and privately run central bank that does a lot of regulation of the economy. So now we see where the Fed's measures are going to actually increase the Fed's regulation of the economy. And in my opinion, that's going to just have the effect of squeezing smaller banks out and only preserving the larger banks. That's generally how it works. Anyway, we're kind of getting toward the nitty gritty here. The risks of doing too much or too little are not in balance yet, Powell said. It may be that we don't move for a meeting and then move at the next meeting in terms of rate hikes. We see the effects, get this part, we see the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. And see, they're very slow to admit or acknowledge that if you keep raising rates and you say you're fighting inflation when in fact you oftentimes are causing it, the amount of economic activity is going to take a drastic nosedive. Mortgages will not be lent. Therefore, houses will not be built. Therefore, housing materials will not be sold. Therefore, trees will not be milled in some cases, you might say. The entire economic chain is affected, Brian. And so what I'm trying to do today is kind of unmask the Fed's deception and its oversights, the things it's overlooking, that is. And it's really misleading what's in the mainline press. I don't know if you have any quick comments or reflections, Brian.
I'm going to have to say we need to move on with the segment, Mark, just to keep an eye on the clock.
Yeah, of course. Anyway, another segue of this is, should you open a CD before the next Fed rate hike? And there is something of a minor advantage, you might say, in the Fed's rate hikes. Moving on from there, we see while higher rates make everything from credit cards to mortgage refinancing more expensive, and as I say, when you don't have mortgage refinancing or you don't initiate mortgages, a lot of economic activity doesn't happen. These rate hikes do have one benefit: higher rates on savings vehicles like high yield savings and certificate of deposit accounts. So on the interest side, in terms of earning interest, there's a little bit of an advantage, but of course that also benefits the banks. And the latest data from the Fed itself, U.S. credit card debt is a record $988 billion. Moving on from there, Americans continue to pile up credit card debt, edging close to $1 trillion. And as far as I can tell, this is the highest thing on record ever since the Fed has been keeping records. We'll look at this here. High inflation is certainly contributing to Americans' high credit card balances, along with record high interest rates. Ted Rossman, senior industry analyst at Bankrate, said more than a third of U.S. adults have more credit card debt than they do emergency savings, the highest we've seen since we started tracking this in 2011. And so on top of the fact that the Fed's rate hikes will make the credit cards more expensive, we have at the same time Americans using credit cards more than ever. Credit card interest rates are also playing a role in the higher total debt, reaching record highs this year, Rossman said. The average credit card APR recently soared to over 20%, higher than at any point since the Federal Reserve began tracking annual percentage rates back in 1994. And I think we're winding up here in the next slide. Although inflation is cooling, the price of housing, transportation, and some food items remain elevated. Credit cards have become the go-to option for consumers as wage growth hasn't kept pace with inflation. And then from there, we have credit cards are not the only debt that has ballooned. Americans owe a total of $1.5 trillion in auto loans, $1.6 trillion in student debt. And the Supreme Court just ruled not to forgive most student debt. They're still going to have to pay it. And $12 trillion in home loans, according to the Fed's own data. So as the rate hikes go up and the interest rates attached to all these things go up, as those rate hikes take effect in affecting housing and credit cards, Americans are literally being buried in debt, Brian. And the Fed only seems to have one tool in its toolbox, and that's keep raising rates. And so you can see how many dimensions of this issue are not being reported so people can see the full outlook and effects. So there you go.
Okay, Mark, thank you very much for that. Well, the key question is Fed friend or foe? I think they are foe, but we can talk more about that again in extra time. So I look forward to that.